Okay, wait. Lewis just texted me and I laughed, I'm not gonna lie. He goes, bro, should I wait until I have like 10 grand saved before I start investing? Feels weird putting in small money. And I typed back, how long have you been waiting to save 10 grand? Three dots, three dots, three dots. 4 years. Yeah, that's the conversation. That's the whole video, honestly. But let me explain why Lewis is wrong, why I used to think the same thing he did, and why $100, literally $100, might be the most important money you ever move in your life. So here's what nobody tells you when you're starting from zero. The first thing you need to fix isn't your income. It's not your spending habits. It's not even your debt, technically. The first thing you need to fix is the story you're telling yourself about what enough looks like before you start. Because that story, it's a trap, and most people live in it for years. I grew up in a house where money was one of those subjects that just didn't get discussed at the dinner table. Not because we were rich and it didn't matter. The opposite. It didn't get talked about because it was painful, and painful things in a lot of households just get silently agreed upon. Nobody brings it up, everybody pretends it's fine, and then one day you're an adult and you realize you never got the memo on any of this. So when I finally started figuring things out in my 20s, I kept making this one mistake. I kept waiting for a raise, waiting for a better month, waiting until it made sense. And that waiting cost me not hundreds of dollars, but years of compounding that I'll never get back. The $100 portfolio challenge isn't about $100, not really. It's about proving to yourself, your actual, literal self, that you can begin. Because beginning is the only thing that matters right now. Let's talk about why small money isn't small. In 1928, if you had invested $100 into what would eventually become the S&P 500 index, just left it there, didn't touch it, didn't panic sell in 2008, didn't do anything, that $100 would be worth somewhere around $500,000 today. Adjusted for inflation, that's still transformational money. Now, I know what you're thinking. Adam, I don't have 100 years. Fair point, you don't. But the math still works in your favor over 20, 30 years, which if you're in your 20s or 30s right now, is exactly the runway you have. Here's the thing about compound interest that nobody explains in a way that actually lands. People always say, your money makes money. Okay, cool slogan. But what that means in practice is this. Imagine you're rolling a snowball down a hill. At the top of the hill, the snowball is tiny. It picks up a tiny bit of snow with each rotation. But at the bottom, that same rotation picks up 100 times more snow because the snowball is 100 times bigger. That's compound interest. The rotations are the same. Time is the hill, and you're already at the top of it, which means the worst thing you can do is stand still. $100 invested today at an average return of 10% a year, which is roughly what the S&P 500 has historically returned, becomes about $170 in 5 years. Not impressive, right? But keep going. In 20 years, that $100 is around $670. In 30, it's over $1,700. Now imagine you're not just investing $100 once. Imagine you're doing it every single month. Now you're building something. That's the game, and the only way to lose it is to never start. All right, let me actually walk you through what a real $100 portfolio looks like. And I mean real, not some theoretical chart on a whiteboard. Actual current options for someone sitting down today with literally $100 in their account and a genuine desire to make it mean something. Before I do that, though, I want to tell you something that's going to sound contradictory. I almost want to unsay it immediately, so bear with me. I used to think diversification was for people with money. Like, oh, once I have real money, then I'll spread it around. But with $100, just throw it at one stock, pick a winner, and stack from there. That was wrong. I'll walk it back right now. That's actually backwards. When you have small money, you can't afford to lose it, which means diversification matters more, not less. The irony of being poor is that the less you have, the more carefully it needs to be protected. Rich people can lose 20% and shrug. You lose 20% of $100 and it feels like a gut punch. And worse, it destroys your confidence before you've even built any. So I was wrong about that. Diversification isn't for when you have money, it's for right now. So, $100. Let's build something. Step 1. Pick a brokerage that doesn't charge you to exist. This might sound obvious, but it still catches people off guard. There are platforms out there, Fidelity, Charles Schwab, Webull, Public, where you pay zero commission per trade, and you can buy fractional shares. That last part matters. Fractional shares mean you don't need $400 to buy one share of a company trading at $400. You can buy $25 worth. This is what makes the $100 portfolio actually possible in 2024. And right now, understanding this for the first time feels like someone just handed you a door key you didn't know existed. Step 2. Don't try to pick individual stocks. Not yet. I know that's not what you want to hear. You want to find the next Nvidia, the next Amazon, the next thing that goes up 4,200% and makes you the guy at the family dinner who saw it coming. But here's the honest truth. Professional fund managers, people whose entire career is picking stocks, the ones with Bloomberg terminals and MBA degrees and Reuters data feeds running 24 hours a day, the majority of them fail to beat the market over a 10-year period. The majority. So what are the odds that you're going to pick better than them? Instead, let the market do its thing. An ETF, an exchange-traded fund, is essentially a basket of stocks. When you buy one share of something like VOO, which tracks the S&P 500, you're buying a tiny piece of 500 of the biggest companies in America at once. Apple, Microsoft, Google, Amazon, Berkshire Hathaway, all of them in one ticker with one purchase. With $100, here's a simple allocation that actually makes sense. Put $60 into a broad market ETF, something like VOO or VTI. Both track the total US market, both have incredibly low fees, and both have historically returned somewhere around 10% annually. This is your foundation. This is the boring part that actually works. Put $20 into an international ETF, something like VXUS, which gives you exposure to thousands of companies outside the United States. Why? Because the US market is incredible, but it's not the only game in town. Some of the best growth over the next 20 years might come from markets we're not even looking at right now. This is your insurance against betting everything on one country. Put $10 into a bond ETF, something like BND. Now, I'll be honest, if you're young and your timeline is long, bonds are controversial. Some people would tell you to skip them entirely. I'm suggesting $10 here not because bonds are going to make you rich, but because a small allocation to something that doesn't move the same way stocks do gives your portfolio a little bit of shock absorption. It's training wheels. You can remove them later. And the last $10, put it into one single stock that you actually believe in. One company you understand, you use, you think is going to be around in 30 years. This is your feel-it position. It's small enough that if it goes to zero, you're okay. But it's there to keep you engaged, to make you care, to make you look at your portfolio and have an opinion about something. That's your $100 portfolio, 60, 20, 10, 10. It doesn't look like much. It feels like practically nothing. But you have something now that Lewis doesn't. You've started. Here's where I want to take a small detour, and I promise it comes back around. My mom used to make this fish dish, right? A simple stew, nothing fancy. And every time I'd watch her make it, she'd spend the first 20 minutes just getting the base right. The aromatics, the heat level, layering the flavors. I used to get impatient as a kid, like, when are we eating? Just throw the fish in. But the thing is, once the base is right, everything else happens fast. The fish goes in, it's done in minutes, and it tastes like something that's been cooking for hours. You can't rush the base. Investing is the same. The first $100, the setup, the brokerage account, the choosing what to buy, that's your base. It takes more time than you think it should. It feels slow. But once it's there, every dollar after it is faster, easier, and more meaningful. You're not starting from zero anymore. You're adding to something. And emotionally, there's nothing like seeing your first real position in a real account. Not a practice account, not a paper trade, not a hypothetical number you calculated on your phone. A real position with real money that you worked for. It hits different. Now, let's talk about the biggest mistake people make after they start. And this one takes people by surprise because they don't see it coming. They watch the price go down and they panic. We need to talk about this because it will happen, guaranteed. You're going to open your portfolio one day, maybe next month, maybe next year, and it's going to be down. Could be 5%, could be 20%. In 2020, during COVID, the market dropped about 34% in 5 weeks. 34%.
People who had been investing for years saw their portfolios cut by a third. And here's the hard question. What would you have done? The people who sold in March 2020, they locked in their losses. The market recovered completely by August of the same year. The people who bought more during the crash, they made extraordinary returns. The people who did absolutely nothing, they were fine. Red numbers in your portfolio aren't losses. They're only losses if you sell. Until you sell, it's just a number on a screen, a temporary number. And the history of every market downturn is the same. It came back. Every single time. Sometimes it took months, sometimes it took years, but it came back. So when your $100 portfolio shows you negative $2 one morning and some part of your brain says, see, this is why I shouldn't have started, that voice is the enemy. That voice has cost ordinary people more generational wealth than any market crash ever did. Ignore it. Feed the portfolio instead.
Speaking of feeding it, let's talk about what happens after the first 100. This is where things start to get genuinely interesting, because the psychology of a portfolio is strange. Once you have one, you want to protect it. Once you want to protect it, you start thinking differently about money. You start doing math you never did before. You look at a necessary subscription and think, that's $8 a month. That's nearly $100 a year. That's a whole additional portfolio contribution. Your brain reframes, not because some guru told you to, but because you have something real to protect now. The goal after your first 100 is simple. Automate the next one. Set up a recurring transfer, even $20 a week, even $50 a month into your brokerage account. Make it automatic. Make it something that happens before you even see the money. This is called paying yourself first, and it sounds like a cliche until you actually do it and realize that you genuinely don't miss the money you never saw. $20 a week is $1,040 a year. Over 20 years with average market returns, that single habit, $20 a week, started today, becomes somewhere around $60,000 without doing anything, without picking the right stock, without timing the market, without a finance degree or a Bloomberg terminal or anything except the willingness to set up an automatic transfer. And $60,000 is a down payment on a property. It's the seed capital for a business. It's the fund that lets you quit a job you hate and take 3 months to figure out what's next without panicking. It's freedom, not abstract freedom. Actual, practical, documented, sitting in your account freedom. That's what $20 a week looks like. And it starts with 100. Let me close with something Lewis said to me that I actually think about a lot. After I explained all of this to him, the ETFs, the fractional shares, the automatic contributions, he went quiet for a second. And then he said, so the people who are rich now, they just started earlier? And I said, mostly, yeah, that's most of it. And he said, that's kind of depressing. And I get it, I really do. It feels unfair that the single most important variable in building wealth is time, something you can't buy, can't hustle your way into, can't find a hack for. If you're 30, you genuinely wish you'd started at 20. If you're 20, you wish you'd started at 15. But here's the thing, and this is the part that actually helped me when I first understood it. Today is the youngest you will ever be again. Not tomorrow, today. The version of you sitting there right now reading this, you are younger today than you will be tomorrow, than you will be next year when you finally feel ready. There is no future version of you that will have more time than you have right now. And $100 is not a small amount of money, not where it's going. It's the first proof that you decided something, that you looked at the system, the one that keeps people waiting, keeps people comfortable with waiting, keeps people in jobs that drain them and lifestyles that trap them, and you decided to opt out, even just a little bit, even just $100 worth. That decision is the expensive part. The $100 is just where you document it. So open the account, make the transfer, watch it sit there, doing basically nothing for a while, and let it sit. Come back in a year, add more. Come back in 5 years. I promise you, you will not regret starting. You will only ever regret the version of yourself that waited.